Okay, dear financial management students, I'm Abeel Ahmed, financial management expert. Let us discuss this question. That is question, I've taken this question from pre-scene mock, September 2026. Let's go into the details of this question. Mainly, I would say this question is on business valuation. Why is valuation of equity of a company necessary? Why it is necessary? This is the question, okay? To find out the answer of this question, no need to read the scenario. Just from the choices, you can very easily decide. Why is the valuation of equity of a company? It's necessary. Let's see what examiner says. The company is planning to raise equity finance, so it makes sense. If we are planning to raise the equity finance, obviously I'm going to issue shares to raise the finance. So I need to know what is the value of my company. The company wants to establish the terms and conditions for merger and acquisition. Again, makes sense. If two organizations, they are going to merge, or let's say one organization is going to acquire another organization. So obviously, before even giving offer to that company, I need to know I need to value that organization. When two organizations, they are going to merge, how can we decide the terms and conditions if each one of us, we don't know what is the value of each company? Okay. The company has a primary focus on mission-driven activities, not profit motive. That's a illogical thing. Read it again. It does not go with the why company wants to value their equity. The company has a primary focus on mission-driven activities, no profit motive. So why would I start a company if I have no profit motive at all? By the way, state number 3 has no link with what question is asking. So logically, statement number 1 and 2 is correct. I'll go with option A. Okay, that's great. Let's see the next one. What is the asset value of a small company using net realizable value? Now listen to me, students, carefully. Whenever your examiner says, give us the value of the asset, but on the basis of net realizable value. When it says net realizable value, NRV, logically, when I'm going to value the business on the basis of net realizable value, it means I'm going to actually sell each assets individually. I'm going to sell non-current assets separate. Everything I'm going to, all the asset, I'm going to sell it separately. So that is, this is how I'm going to find out the net realizable value. Another point, why would a business will go for net realizable value? Normally, when going concern assumption is not valid, then you will go for net realizable value. Another important concept, if I'm going to value the business on the basis of net realizable value, then obviously, if my examiner gives me the goodwill, so I will consider the value of that goodwill 0 when I am going to value the business on the basis of net realizable value. Because try to understand, net realizable value means, make it in another way, then logically, let's say I'm going to sell each individual asset. If I sell separately, so what amount I'm going to get? So obviously, I'm not going to get anything against the goodwill. I cannot sell goodwill separately. Logically, when do we get, I would say, consideration against the goodwill? When you are selling the entire business with a valid going concern assumption, then obviously you will be getting the consideration against the goodwill as well. But when it comes to net realizable value, if your examiner gives you the goodwill, so you have to ignore it. Let's see. Ernst company is a well-diversified company that has successfully grown over the years by adopting the strategy of inorganic growth. Inorganic growth means they have been acquiring other organizations. 3 acquisition opportunities have been identified as follows. Small company manufactures parts required for automobiles. The extract from its statement of financial position on 31st March X4 is given below. Non-current assets 1275. We have got inventory 280, receivable 520. So the total current asset, they are 800. Non-current asset include goodwill 250. As I just mentioned, you have to ignore the goodwill. Just a minute. From this 1275, I'll deduct 250. The non-current assets are considered worth 80% of their book value. Book value means what is written in SOFP. 1275 minus 250. I'm getting 1025. But logically, 1025 is not the net realizable value. Question says non-current asset, they're worth 80% of their book value. So after deducting the goodwill, the value of the non-current asset is 1025. I have to take 80% of this. I'm getting 820. Wow. The inventory is net of an obsolescence provision of 40,000. This 280 is after the deduction of obsolescence provision of 40. So they have deducted the provision of 40, and after deducting the provision of 40, the value is 280. Okay. Going forward, the obsolescence should be brought down to 20,000. But they are saying it should be brought down to 20,000. So from 40, it should go down to 20, which means that logically I should add back 20. So inventory value should be 300. The receivable are expected to yield 90% of their book value. So I'll take 90% of 520. I'm getting 468. So here comes net realizable value. 820 plus 300 plus 468. I'm getting 1588. Okay. 3 zeros we have to ignore. So it's 1588. So far it looks easy. Calculate the market value per ordinary share of medium company using P ratio method to the nearest 2 decimal points. Now here you need to learn one thing which is very important. We know that whenever we need to value a private company by using P ratio, so obviously private company does not have its current share price because it is not listed on the stock exchange. So it's very difficult for us to find out the directly P ratio of a unlisted company. Then what to do? In that case, we need a P ratio of a similar size listed company, number one. Number two concept is very important. Obviously, on listed organization, the confidence of the shareholder is higher as compared to a private unlisted company. So normally what happens, we do first calculate P ratio of a similar size listed company, step one. Then logically we reduce that P ratio so that it should be fitted for a private company, because on private company the confidence is going to be lower than the listed. But listen to me, if you are facing a question either in section A or B, and where your examiner says value the P value, find out the value of a company by using P ratio, and that company, that organization is a private company, obviously examiner will give you the similar size listed company. You are going to calculate, let's say, P ratio of a similar size listed company, or there is a possibility examiner might give you directly the P ratio of a similar size listed company. But now listen to me carefully, which I'm saying right now. If it is a question in section A or section B, then examiner will have to mention how much P ratio of a listed company I should reduce so that I can utilize for a private company. If examiner does not mention anything, then we do not have a single, I would say, acceptable reduction. Because logically, how much listed company P ratio should be reduced so that I can utilize that for a private company, that reduction is arbitrary. It is up to your will. So that something which is arbitrary, which is up to my will, I cannot utilize such things in section A and B, because in that way I will end up by making a mistake. Now what should be done? If examiner does not mention how much listed P ratio should be reduced so that it can fit for the private company, it means that if nothing is mentioned, then whatever similar size listed company P ratio examiner is going to give us in section A or section B, we will be using the same P ratio to value the private company. But if the same thing comes in a long question, let's say 20 marks question, which does not come, but if it comes, then obviously if I give the reference of AFM, of course in AFM, when we value a private company, we do first calculate similar size listed company P ratio, then we reduce that. Of course, I'm going to write, it is assumed that a listed company P ratio will be reduced by 20%, maybe 30%, so that it can fit for a private company. But this kind of flexibility is not available when we are solving FM section A or section B question. So if how much should be reduced, nothing is mentioned. Whatever P ratio you are calculating for a similar size listed company, or whatever examiner gives you the P ratio of a similar size listed company, you are going to use the same P ratio to value a private company. Now read it again. Calculate market value per ordinary share. They just need P naught. Market value per ordinary share of media company using P ratio method. Okay, fine. Actually, P naught is equal to, we just need P naught, current share price. Okay, if we know EPS, earning per share, just multiply this with the price P ratio, PE ratio, EPS into P ratio. If we know what is earning per share, if we know P ratio, just we need to multiply both of them in order to get P naught, current share price. Okay, now come here. Medium company is an unlisted company engaged in manufacturing parts of aerospace industry. It earns profit after tax 8,50,000 during the year. It has 1 million ordinary shares. So EPS of, I would say, this unlisted company is going to be 0.85. Okay. A listed company engaged in the same sector. Posted EPS 1.2. It has a P ratio 10 times. So since examiner has not mentioned how much it should be reduced, so whatever examiner is given, we are going to utilize same. So P naught is equal to EPS, we have calculated 0.85. P ratio is 10 times. So P naught becomes 8.5. So the answer is 8.5. Okay. Which of the following correctly represents the value of Alpha's startup company using discounted cash flows basis to the nearest triple zeros? Okay. Alpha startup is engaged in the software development. Its new software is fast becoming popular and market seems to be promising. The cash flow projection in the first year cash flow, second year, third, fourth, post year 4 means after year 4, the cash flow are expected to rise by 2% perpetually forever. The cost of capital estimated is 11%. So all we need is just calculate the present value of all cash flows from year 1 till infinity. Sum of that is going to be the business value. So year 1, 2, 3, 4, and 5 till infinity. Cash flows 130, we are ignoring 30, 180, 210, 240. Then from year 5 till infinity, 240. The growth rate is going to be 2%. Cost of capital is 11 minus this. Okay. Discount factor, they have given us 11%. So let's see what we are getting. 1 divided by 1.11, 0.9, 0.81, let's say 2 with a little bit rounding off, 0.731, then 0.659, and here we'll be using a 0.659 as well. So very easily, 130 multiplied by 0.9, 117, 180 into 0.812, 146.12, let's take it 146, 210 into 0.731, 154, 240 into 0.59, 158. First, student, you have to solve this bracket or this complete fraction, I would say. Whatever answer comes, multiply by 0.659. In our regular classes, we spend on this concept, I think, around 30 minutes. Okay, we have already covered this many times in our regular classes and practice classes as well. So here I'm just directly solving it. So first you have to solve this fraction, whatever the answer comes, that will be multiplied by 0.659. So 240 into 1.02 divided by 0.09. I'm getting the answer of this fraction 2720. Multiply by 0.659. I'm getting 1792. Let's add all of them. Students, I'm getting 2367. If you are not getting the exact answer, this is the business value. If you are not getting the exact answer, then we'll go to the nearest one. 2300. We are getting the exact answer. Delta is the answer. 2367. Okay. Which of the following is correct? Correct way to calculate the market capitalization of a listed company is very simple. Market capitalization of a listed company is equal to issued shares by the listed company multiplied by current share price. Number of ordinary shares in issue multiplied by the current market price per share. Straightforward. The first one. No need to read even the rest of the options at all. So market capitalization is number of ordinary shares issued multiplied by the current share price when we are calculating a market capitalization of a listed company. So student, that was a one of the question which we have taken from pre-CMOC September 2026 attempt, and this question is actually on business valuation. And don't forget to get benefit from our crash courses, as I mentioned many times in my other videos as well. In financial management, we have actually introduced two types of crash courses. One is a topical crash course. Just by spending 5 to 6 hours, you can revise the each and every concept of financial management. So just think, by spending 5 to 6 hours, you can revise the entire financial management. Second crash course is again 5 to 6 hours long, but the good thing is, in second crash course, student, you can revise again the entire FM through questions. So one is a topical crash course, another is a question-based crash course. And in ACCA, in each and every paper, we actually provide regular classes. We do provide crash courses as well. And the crash courses which Abeel School of Accountancy provides, nobody provides the same crash courses anywhere in the entire world. Just imagine, if I talk about taxation, just within 6 hours, you can revise the entire taxation. FR, you can revise within 7 to 8 hours. FM, I've just mentioned. PM, you can revise the entire PM just within 6 hours crash course. SBR, there are two types of crash courses. One is ISS, IFRSs, you can revise within 7 to 8 hours. Consolidation of SBR crash course is 7 hours long. ATX crash course is hardly 10 to 11 hours long. AFM crash course is around 15 to 16 hours long. So the crash courses which ASEP actually provides, you will not be getting the such crash courses and regular classes anywhere in the entire world. Plus, student, don't forget one more thing. We are the only institute we conduct your live revision classes as well. So thank you very much for watching this video. Thanks a lot.